Welcome back to another quick stock analysis, and today I'll be looking at Activision Blizzard.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul. Now today I'm going to do a quick stock analysis through fast graphs on Activision Blizzard. Activision Blizzard, looking at the corporate website, it's a gaming company, very popular at the moment. It's got some of the big and, to be honest, some of my favorite games out there. Like Crash Bandicoot's a big one for them, but look at this. World of Warcraft, Call of Duty's a massive one, Overwatch, and I played a lot of Diablo as a kid, so it's got a place for me, Activision has. Long term, Activision stays along its peg really well, growing at a peg ratio of 20 long term. Just to remind you, I look at 5 things to just provide one big look at this company. I don't look at any of their quality data right now. This is just for me to look at straight away, to take a big step back from the company and look at it from a distance and see, right, is this company worth me looking at in greater detail? Because Peter Lynch said you've got to look at 20 stocks just before you buy one, and this is my quick way of getting through these companies to figure out if they're in the right value for me to buy right now. And to help me with this process, I've developed a criteria to help me work through these companies. I try to look at top line revenue, Ebitda growth, then I'm looking at debt, and I want it to be justifiable debt or being paid down. And then I want free cash flow. Then I'll look at some analyst estimates, and then I'll try and find some value at the end. And I'll show you how I'm going to do this. Right, we'll start off with revenue growth over the past 10 years. And it looks like it's growing, not massively and not really quickly, only 7% year on year. Drop it down to 5 and it does go up 13%. So over the past 5 years, Blizzard has been growing its revenue, which is quite good. At 13% double digits, that's pretty good. Then I'll move on to Ebitda growth over the past 10 years. Yep, looking good. 12% year-on-year growth of Ebitda, looking pretty good to me. Over the past 5 years, we've gone from 1.8 billion in profit to 3.34 billion profit. Massive gain. It's been a bit sketchy over that time, but in general, the trend is going upwards. Looking at free cash flow, I always look at free cash flow because free cash flow is the most important to me. If this company is paying a dividend, which I actually don't know if it's paying a dividend right now, or it's buying back shares, which I know it is, then you need to know this company is generating cash. And over the past 10 years, Blizzard is growing its cash. It's gone from 1.2 billion all the way up to 2.1 billion. Over the past 5 years, that's got even better. A 17% year-on-year growth in cash looks pretty good. General trend, again, upwards, but a little bit choppy in the middle. There might be something happened in 2018. That was when we saw that massive drop. So there might be something there, something that you should probably look into as you go forward. And with Blizzard, this definitely surprised me. It's actually paying down its debt. Long term, it's been paying down its debt, which is very good. It's gone from 4 billion in debt down to 3 billion in debt, or 5 billion in debt down to 4 billion in debt. But very recently, the debt is going up. I imagine it's got a lot to pay for. The console cycle's coming up. It's obvious that this company's still growing. It's still nowhere near 2016 level debt. So this debt does look justifiable, and there's no reason based on its free cash flow why it can't pay off that debt. I just want to look at the current ratio, because usually when a company is paying off a lot of debt and it's slightly growing, I just like to try and find out how well it can pay off its current liabilities. So that's basically anything in the next year. You're looking for this with the current ratio, you're looking at the total current liabilities versus the total current assets. And a current asset is generally defined as 1 year. So over the next year, can this company pay its bills? And if this company has a current ratio of 1, then it's considered able to pay its bills. You'd love a company to have a bit more cash on hand to pay its bills, but a current ratio of 1 is just about safe, and we'd love to see it over 1.5 at a minimum. And right now, Activision is showing a current ratio of 3.41, which means this company is well placed to pay off its short-term liabilities. Just looking at what the analysts are saying over the next couple of years, this is 32 analysts, 30 analysts, and 17 analysts. So this is a lot of analysts getting on this company. Seen a 53% earnings growth this year, apparently. But next year they're saying 5%, 14% after, and 9% after that. So they're not really considering that this company is going to grow much over the next few years. I don't like that this has set this at a 15 PE, so I'm just going to go into the custom, because this company generally trades at a 20 price to free cash flow. Let's just drop this into free cash flow as well. So this company trades at a price to free cash flow of 20 usually, so we'll set that at 20 right there. And analysts think this is going to grow over 20% free cash flow in the next 2 years, 5% in the years after that, and then it's guessing 10%. That's based on previous growth until 2026. And based on that 20 free cash flow, we can see the price ending in 2026 at $115. It's currently sitting, what's the price at the moment? The price is currently sitting at $93. So if everything goes really well for Activision right now, and there's reason to think that there's a lot of tailwinds going on in this industry right now, you could probably earn 4% year on year over the next 6 years. I don't think this is a particularly good deal, because I think this company has shot up quite considerably over the past few years and is now into overvalued territory. And history shows, I'm just going to drop this down to a 10-year graph, and history shows that when this company gets overvalued, the price reverts to the mean. So I would be a little bit scared of that, and I would personally not be buying into this company right now. Just to go back to fair value, this company probably needs to drop 30%. In my eyes. Like, in your opinion, this might be totally different. But for me to consider it at a really good value, I would probably want it back at $50 a share. That would provide me a really good growth in the future. That would provide me 16% year-on-year growth. You know, a real good possibility of growth in the future. Right now, at the prices that it's at, you know, 92.58. We're not seeing a lot. We're seeing 4%. So this company might continue to benefit from all the hype and the tailwinds from the gaming industry. There's no doubt the gaming industry is going to be absolutely massive in a couple of years. I personally have the VanEck gaming industry ETF, so I've bought into this overvalued as well. But there must be some individual companies in this space right now that are less risky. And when I'm saying risky, I'm not saying the company is bad. I'm saying that the share price is overvalued. And for me to consider a company, I want to be paying less than it's actually worth. Now, a lot of people will guess that, you know, we could go to the forecasting and say that this company could be worth, if it generates a 20% year-on-year return over the next 6 years. Let me pop this back to 92.58. You know, if this does generate a 20% year-on-year return over the next 5 years till 2026, you will see a 19.16 return. But that is really, really good positive growth, and everything has to go right for Activision at this time. At the moment, I'd like to see it come down to $50 before I get in, but if it did, I would be all over it. Thank you very much for watching, everyone. And if you enjoyed this video, please feel free to like, subscribe, and invest.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.